Before we start, let us address the elephant in the room. Can an algorithm predict the stock price accurately? The answer should be obvious to anyone who trades. A machine cannot predict a drop in sales, a profit warning, a recession, a global pandemic, or any of the factors, positive or negative, that would impact the price of a stock. If we can't predict the stock price with 100% certainty, is it possible to forecast the stock price to a reasonable degree of probability? The Theta 45 algorithm is a probability trading indicator with real-time artificial intelligence. And in this episode, we look at what that means and how it is used to forecast the next closing price. Let's keep things simple and start off with what we know for sure. At the end of the trading day, we know the last close price. The second thing we know for sure is that the next close price will be the last close price plus a change in price. Delta P can of course be positive or negative. Or alternatively, we can say that the next close price will be the last close price plus a portion of the last close price as defined by the percentage change R. What we don't know for sure is what will be the percentage change R the next trading day. Theta 45 takes a probabilistic approach to forecast the value of R the next trading day. The first step for the Theta 45 algorithm is to create a probability space, which is constructed from three components: a sample space, an event space, and a probability distribution function. A sample space is a finite set of all possible events. These are the sample spaces for a dice, a deck of playing cards, and a roulette wheel. As we saw in the previous episode, the range of possible values of R, the percentage change, stretches between -100% and plus infinity. To create a finite set for a sample space, Theta 45 uses the angular return. Click on the link to see the mathematics behind the angular return. Using this sample space, Theta 45 measures the frequency of occurrences for each angular return to create an event space, and then divides each frequency by the total number of events to create a probability distribution function. Using this function, Theta 45 can now calculate the expected value of the next angular return and a standard deviation. We can now process this probability trading indicator through a real-time artificial intelligence algorithm. The Theta 45 algorithm grabs the last period of historical prices and calculates the daily return as a percentage, then converts each percentage into an angular return. The set of historical angular returns used are always divisible by 16. The trader can select a period of angular returns ranging from 16 to 256 trading days. The set of angular returns is divided into 8 sections, and the expected value for each section is calculated. All 8 expected values are then weighted, using their own respective weight to calculate a weighted value. The 8 weighted values for each section are added together to produce a total weighted expected value. Theta 45 then uses one of 10 real-time AI models to adjust the weights according to its own personality and recalculate the weighted expected value. Some AI models adjust the weights to emphasize the more recent price activity. Other AI models use the concept of reinforcement learning and a backpropagation algorithm to forecast the next closing price based on the actual closing prices of the last 64 days of trading. The Theta 45 algorithm converts the weighted expected value and the standard deviation from an angle to a percentage. The weighted expected value is used to calculate the predicted price for the next trading day. The standard deviation is multiplied by 2 and subtracted from the weighted expected value to calculate the lower end of the forecast range. The standard deviation is multiplied by 2 and added to the weighted expected value to calculate the upper end of the forecast range. The mid price indicates the trend of the period of prices used in the forecast. And in theory, there is a 95% probability that the stock will close between the predicted range. The odds screen shows the actual probability in blue for the forecast range corresponding to a standard deviation of 0.5 and a standard deviation of 1, 1.5 and 2. The last odds is the percentage probability that the next close price will fall outside the forecast range. The signal screen also shows the corresponding bands in the forecast range. These are the corresponding forecast ranges in the signal risk screen, the backtest screen, and finally the volatility screen. And in the next video we use these forecast ranges and the backtest screen to create a day trading strategy.
Subscribe to our YouTube channel for more trading strategies with Theta 45. And smash that like button if you found this video helpful. Theta 45 is available to download. Use the link in the description and create your own trading plan now.